Good day, Junior Tickies. I'm Mrs. Bromacombe, and in this chapter, we are going to look at companies' new transactions. Now, just to go back, in grade 10, the focus was on a sole trader. In grade 11, on a partnership, and in grade 12, the focus is now going to be on a company. And the first thing that we are going to look at is the selling of shares or the issuing of shares to the public. Now, why would a company decide to sell shares to the public? If a company needs money, they need capital, they can either borrow money from the bank or they can decide to sell shares to the public. IPO is the initial price offering, the first time the shares was issued to the public at a specific price. Now, a company can decide to sell shares at a different price. Now, who decides that? The directors. The directors run the company on behalf of the owners, which is called the shareholders. Now, shares can be issued at different times, at different prices, and for that reason, my ordinary share capital is always at average price or the book value, and this is very important to remember moving forward. So if a company decides to sell shares, that money will be deposited into their bank account, which means that bank will be debited. And if bank is debited and we have a favorable bank balance, our assets will increase. If we have an unfavorable bank balance, it means that our liabilities will decrease. Ordinary share capital is a shareholder's equity account, which means that when we sell shares, that will increase, and that's why our owner's equity on the accounting equation is plus. So looking at activity 1, we need to complete the ordinary share capital in the general ledger, accounting equation, and the ordinary share capital note. There's other questions that we're also going to complete, which we will look at a little bit later on. So when I approach this question, I don't need to start with question 1 and then question 2 and then the third question. As I go through the information, I'm going to fill it in exactly where it's supposed to go. So if I start with the information given, you are provided with the information relating to AR Limited. The financial year ends yearly, 30 June. The company has an authorized share capital, which means maximum of 1,250,000 ordinary shares, and 60% of them were in issue on the 1st of July 2020. That is the beginning of the accounting period. Now, if you go down to information A, it says 30 June 2020. That is not a mistake. The closing balances at the end of last year is my opening balances this year. My accounting period currently ends 30 June 2021. So if I start with my calculations, we've got 1,250,000 shares times 60% means that 750,000 are in issue. So if I go to the ordinary share capital note, I'm going to say the authorized and 750,000 shares is in issue in the beginning, and the total capital is 1.5 million. Now I'm going to go to the ordinary share capital in the general ledger, and I'm going to say July the 1st, balance brought down 1.5 million. On 30 April 2021, the company sold 250,000 shares to the public at R3 per share. So in my ordinary share capital note, 250,000 ordinary shares issued at R3 per share, so the total capital is 750,000. In my general ledger account, I'm going to show exactly the same. April the 30th, bank, 750,000. Effect on the accounting equation: account debit, bank, account credit, ordinary share capital, assets plus owner's equity plus 750,000. Now I can balance the ordinary share capital in the general ledger. the credit side minus the debit side equals 2,250,000. And if I go to my ordinary share capital note and I total it, it gives me exactly the same answer, and the number of shares in issue is 1 million. Now we need to calculate the average price and the net asset value on 30 June 2021, which is the end of the accounting period. Now, if I look at the average price, we can go to the ordinary share capital note and we can find the information from there. The number of shares in issue at the end is 1 million and the capital amount is 2,250,000. So if I divide 1 million, if I take 2,250,000 divided by 1 million times 100 cents, my average price is now 225 cents or 2 Rand and 25. To calculate the net asset value, we are going to take the total shareholders' equity divided by the number of shares in issue. The net asset value tells us what the shares are actually worth. So if I look at the information, the net profit after tax was 320,000. So if a company decides to retain those funds, they didn't pay out any dividends, that is going to be added to your retained income, which means that my ordinary share capital is 2,250,000 plus the 450,000 in the beginning and what we've retained this year. So my total shareholders' equity, 3,020,000 divided by 1 million shares times 100 cents means the net asset value is now 302 cents. If I now compare this to last year, what happened? The net asset value increased, and the reason for this is we've retained more funds, we have accumulated more funds, and we raised more capital. Thank you very much. I want to leave you with this quote: the expert in anything was once a beginner. Next, we're going to look at buying back shares. Hope you have a wonderful day.